Let me paint you a picture. It's 2008. You've done everything right. You bought a house, because that's what smart people do, right? You've got a decent chunk in your 401k, maybe a little savings on the side. You feel prepared. Then, in the span of 18 months, your house loses 30% of its value. Your retirement account gets cut in half. And the savings sitting in your bank account? Inflation and near zero interest rates quietly eat away at its purchasing power year after year. You didn't do anything wrong. You followed the rules, and you still got hurt. Here's the thing. That story isn't just about 2008. It's happening in some version to some degree right now. And the real question isn't, will the next crash come? It will. The real question is, which assets actually survive it? Look, most people think they know what a safe asset is. Cash, a house, maybe some bonds. But here's what most people don't realize. Safety isn't a fixed thing. It's relative to what's crashing around you. Cash feels safe until inflation runs at 8%, and your $10,000 in savings loses $800 of purchasing power in a single year without you spending a single dollar. Real estate feels safe until interest rates spike, and your $400,000 property suddenly can't find a buyer at $300,000. The truth? There is no universally safe asset, but there are assets that have historically held or even grown their value specifically during the moments when everything else falls apart. And most people have maybe one of them if they're lucky. Today, we're going through all 5. Let's start with the one everyone knows, but almost nobody actually owns: gold. Now, I know what you're thinking. Gold is for doomsday preppers and old guys on cable news. But look at the data. During the 2008 financial crisis, the S&P 500 dropped roughly 57%. Gold, it ended 2008 up about 5%, and then rose another 24% in 2009 as fear peaked. During the COVID crash of early 2020, stocks lost 34% in 33 days. Gold dipped briefly, then surged to an all-time high of over $2,000 per ounce by August of the same year. Here's the psychology behind it. Gold doesn't produce earnings, it doesn't pay dividends, but when people lose trust in paper currencies and financial systems, they run to something tangible, something that has been recognized as valuable for over 5,000 years. That psychological anchor is exactly what makes it hold its value when trust collapses. Most financial advisors suggest between 5 and 10% of your portfolio in gold, not 50%, not 0, 5 to 10. Now, you might be thinking, okay, but I don't want to buy gold bars and hide them under my mattress. Fair. So let's talk about the second asset, inflation-protected government debt, specifically I-bonds and short-term U.S. Treasury bills. Here's what most people missed. In 2022, when both stocks and bonds had one of their worst years in history, the traditional 60-40 portfolio lost nearly 16%. I-bonds were paying 9.62% interest. That's not a typo, 9.62%. Why? Because I-bonds are designed to move with inflation. When inflation spikes, they spike with it. They're literally built to not lose purchasing power. Short-term treasuries work differently. They mature quickly, so they're less exposed to interest rate swings. In the same 2022 environment where long-term bonds collapsed, 3-month T-bills quietly held their value and even paid reasonable yields. The catch? I-bonds have a $10,000 annual purchase limit per person, but $10,000 earning 9.62% in a year of financial chaos, that's $962 of guaranteed real return in a year when everything else was bleeding. Here's where it gets surprising. Most people think of real estate broadly, but not all real estate behaves the same way in a crash. Residential real estate crashed 30% in 2008 and took 6 years to recover. Farmland? During that same 2008-2009 period, U.S. farmland values dropped less than 3%, and over the last 50 years, farmland has had negative annual returns in only 5 of those years. Why? Because farmland produces something people need regardless of what the stock market does: food. The demand doesn't go away when the Dow drops 1,000 points. Now, you might be thinking, I can't exactly go buy a farm, and that's fair. But today, you can buy farmland exposure through REITs, like Farmland Partners or platforms like AcreTrader, with minimums as low as a few $1,000s. Similarly, commodity ETFs, tracking things like wheat, oil, and industrial metals, tend to rise when inflation rises and currencies weaken. In 2022, while stocks fell 20%, the Bloomberg Commodity Index rose over 16%. That's not a coincidence. That's the inverse relationship between real assets and financial assets working exactly as designed. Now, here's the one that nobody puts on a list like this, but it might be the most important one: your skills, your human capital. Think about it this way. In 2008, if you were a financial analyst with 10 years of experience and a strong network, your asset, your earning power, didn't lose 30%. It might have taken a temporary dip if you lost a job, but it came back, and skills compound in a way money can't always replicate. Here's a number that should reframe how you think about this. A 1% improvement in your earning ability through a certification, a new skill, a better negotiation can compound over a 30-year career into hundreds of thousands of dollars more in lifetime earnings. And here's the most important thing: no market crash, no bank failure, no inflation spike can repossess your skills. They are the one truly crash-proof asset. The most resilient people through every economic downturn in history weren't the ones with the most gold or the best stocks. They were the ones who could create value for others, regardless of what the economy was doing. Invest in your earning power. It's the highest returning, lowest risk investment most people never think about. I know what you're thinking now. Wait, stocks? Didn't you just say stocks crash? Yes, and here's what most people don't realize. Not all stocks crash equally, and the ones that hold value or recover fastest share very specific characteristics. Companies with strong cash flow, low debt, pricing power, and essential products. Think consumer staples, think utilities, think healthcare. During the 2008 crash, the S&P 500 fell 57%, but companies like Walmart, Johnson & Johnson, and Procter & Gamble, they fell far less and recovered far faster because people kept buying soap, medicine, and groceries regardless of the Dow. There's even a category of stocks called dividend aristocrats, companies that have raised their dividend every year for at least 25 consecutive years, through recessions, crashes, and crises. These are companies that have literally never stopped rewarding their shareholders through every single downturn in a quarter century. The key insight is this: you're not just buying stocks, you're buying ownership in businesses. And businesses that produce essential, in-demand goods and services don't go to zero. They bend, they don't break. So let's be concrete. Here's what a crash-resistant portfolio actually looks like in practice. 5 to 10% in gold or gold ETFs, your psychological and historical safe haven. 10 to 15% in inflation-protected instruments like I-bonds and short-term treasuries, your purchasing power shield. 10 to 15% in real assets, farmland REITs or commodity ETFs, your inflation hedge with tangible backing. The largest portion, 50 to 60% in quality equities, dividend aristocrats, consumer staples, low-debt companies, your long-term growth engine with resilience built in. And the investment that doesn't show up in any brokerage account, consistent reinvestment in your own skills and earning power. This isn't a doomsday portfolio, it's a weatherproof one. It's built to grow when things are good and to not collapse when things go wrong. Here's the honest truth. No one rings a bell when a crash is coming. There's no warning email, no countdown timer. The people who are protected when things fall apart aren't the ones who predicted it, they're the ones who were already positioned before it happened. You don't build a roof during a rainstorm, you build it while the sun is shining. The 5 assets we covered today aren't exotic or complicated. They're time-tested, historically validated, and accessible to almost anyone with any level of capital. The only thing standing between you and a crash-resistant portfolio is the decision to start building one. So start today, not because a crash is coming tomorrow, but because by the time it does, it'll be too late to prepare. If this gave you a new way to think about your money, subscribe for more, and I'll see you in the next one.